Dollar cost averaging versus value averaging. They're both viable approaches to ongoing investing, but which will leave you with having a larger nest egg? And are there any other things that we should be considering before choosing which approach is best for us? That's what we're going to be discussing today. Let's talk about the mechanics, pros, cons, and historical performances of dollar cost averaging and value averaging. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So before we go over which approach has historically worked best, let's lay out how each one works mechanically. I won't spend too much time on dollar cost averaging, as I'm sure most of you watching this video already knows how it works. Basically, each month you invest a predetermined amount of money into the markets regardless of how those markets are doing at the time. It's essentially what we're doing when we have money automatically put into our 401ks from our paychecks. If you happen to come into some extra money, you simply decide how long you want to take to invest that money into the markets and add that to your ongoing investments. So if you were investing $500 a month into your 401k and got a small inheritance of $12,000 one year, and you decided that you wanted to invest that $12,000 by the end of the year, you'd simply invest $1,000 a month from that inheritance in addition to your regular $500 a month investment from your paycheck. Pretty simple. Value averaging is fairly similar in that it's also a mechanical approach to ongoing contributions, but it's attempting to accomplish something a little bit different. Instead of targeting a specific periodic contribution amount that you'll be adding to your nest egg regardless of market conditions, value averaging targets a specific net worth level that is trying to hit each and every month, quarter, or year, depending on how often you decide to want to hit your target. So say you were saving up for a down payment on a home, and you wanted to put away $60,000 over the next 5 years, or 60 months. In order to reach that target, you'd need your savings to grow by $1,000 each month. This trajectory is often called your value path. Your monthly contribution under the value averaging method is whatever dollar amount you need to hit that target each month. Sometimes, due to the growth of your investments, you might actually overshoot your target. In that case, not only would you not add any new contributions, but you'd actually sell some of your investments to get back down to that target level. I'll come back to why value averaging handles this situation in this way in a minute when we're discussing the pros and cons. Beyond returns, this ongoing contribution amount can be affected by a few other things, most notably your ultimate savings goal and your time horizon, though occasionally some people will anticipate being able to contribute more towards their savings goal over time, either due to pay raises or the lowering of their living costs by something like paying off debts. In those circumstances, they can add in the expected growth rate of their contributions over the investment period, which will obviously also have an effect on how much they're contributing. But in our hypothetical example, we have 60 months to save $60,000. Assuming our baseline contributions don't change over those 60 months, and we put the money into some high-yield savings account paying us 0.5% in interest each year, we'd have to contribute something in the neighborhood of $988 a month on average to reach our goal. But since we want our savings to grow at a constant rate, in this case $1,000 a month, we won't actually invest that $988 each and every month like we would if we were dollar cost averaging. In the beginning, when our investments aren't making enough in interest to make up for that $12 monthly shortfall, we'll actually have to be investing more. In fact, it'll be nearly the full $1,000 in the first couple of months, and vice versa near the end of the simulation. Based on the math for this particular hypothetical, we'll be investing roughly $975 in the 60th and final month of the simulation. Here's what the yearly contribution amounts and ending net worth would actually look like for this particular hypothetical. So that's how the strategies work mechanically. Dollar cost averaging targets consistent contribution amounts regardless of market conditions. Value averaging targets consistent net worth growth regardless of market conditions. These differences obviously lead to some unique pros and cons. I'll start with a quick overview of the pros and cons associated with dollar cost averaging. Generally speaking, dollar cost averaging has 3 major pros on its side. First, it's relatively simple to understand and follow, as there's no ever-shifting contribution calculations that you have to keep up with. You just pick a contribution amount that you feel comfortable with, decide where you want the money to go, and if possible, make that process for those contributions automatic, such as through payroll deduction on a 401k so that you don't have to think about it again, and after that, you're basically done. Second, because of this, you aren't really required to be regularly watching the market's movements, which for some investors can make investing consistently easier. And third, spreading out the investment of a lump sum over a handful of months or even a year lowers the possibility of you putting all of your money into the markets at a peak. Doing it this way can make investing such a large lump sum easier to stomach for many investors, even if they know that the possibility exists that they'll miss out on some of the gains by not investing the entirety of their their lump sum immediately should the market actually continue to go up during the year. And that possibility is basically the most notable con to a dollar cost averaging approach. Assuming your investments are well diversified, historically speaking, they'll go up more often than they won't. In fact, according to Robert Shiller's data, even the S&P 500, as volatile as it can be, has risen in roughly 62% of the months since 1871, assuming dividends were reinvested. That's not an overwhelming majority of the time, but it is a majority of the time. And the months where the index rose, the percentage change tended to be greater than when it fell. Or in other words, the good months have been more frequent and more good than the bad months have been bad. This means that more often than not, some of the best deals you're going to get on the share prices that you're seeing are the ones that are available right now. So if you're only partially invested because you're spreading those contributions of a lump sum of money out across several months or more, then more often than not, you are going to be missing out on some gains during that time. It may not make a ton of difference depending on how large your lump sum is, how long you're taking to invest it all, and of course how the investment performs over that specific period of time, but more often than not, there will be some lost gains. Value averaging also has a few major pros going for it. First, at least based on the recent price trends, you're always going to be buying relatively low and selling relatively high. This is just because of how the mathematics of compounding investment returns relate to consistently increasing net worth targets. You'll need to contribute more money out of pocket when your investments are making less money than you had thought they would, and less money when they're growing faster than you had expected. If they grow enough, you may even need to sell some of your investments in order to bring your investment's net worth back down to the targeted level. This leads us to the second pro for value averaging, which is that compared to dollar cost averaging, you can get some additional downside protection. Because obviously if you're selling some of your investments after a major market run-up, such as before the dot-com crash or Great Recession, and then the market ends up tanking soon afterward, you'll have less money invested in those markets to lose on paper. And of course, when the market is falling, you'll be using the cash that you got from your recent sales to buy in again at those lower prices. Granted, this aspect of the approach isn't without its drawbacks, as I'll cover in just a second with the cons, but this is why the strategy has you selling some of your investments when they severely overperform your expectations. It's anticipating an eventual market pullback and trying to lower your exposure to that risk so that you can still be in a position to take advantage of the lower prices when they come. A third pro is that the growth of your nest egg is much more steady than with dollar cost averaging. In fact, assuming you're able to make all the contributions and sales when the strategy calls for them, your investing net worth will grow at a rate roughly as consistent as you'd see in a savings account, regardless of whether you're investing in stocks, bonds, or even something more volatile like cryptocurrencies. And that brings us to some of the cons of the strategy. As I see it, there are 3 or 4 notable ones to take into consideration when deciding if value averaging is right for you. The first is that, just like with dollar cost averaging, you're not going to be fully invested all the time. With dollar cost averaging, this really only applies to the portion of time that you're spending investing a lump sum of money, if you have any. But due to the varying sizes of ongoing contributions that are required to follow a value averaging strategy, you're probably going to be keeping some cash on the sidelines for most, if not all, of the investing timeline. And since cash and other incredibly safe and stable investments that you might choose tend to earn less money over the long run than, say, stocks, you could be missing out on gains for a substantial portion of your investing lifetime using value averaging. Again, the difference that this will make in your net worth figures may or may not be all that significant depending on things like your investment's performance, your goals, your time horizon, and how much cash you're actually keeping on the sidelines, but it is something worth taking into consideration. A related potential con to using value averaging is what I like to call the risk of the great bull run. Since value averaging has you invest less money each month when your investments are performing better than you expected, if your investments end up having a really great decade, you could find yourself falling behind other approaches. This is because during that time you're buying less shares, earning less from dividends, and, especially if the strategy has you sell some of your investments in anticipation of an oncoming crash that doesn't actually materialize, experiencing less overall growth. A third potential con is cash exhaustion. This is particularly relevant to those who are saving up for large goals or over a long period of time, because in either case, you're likely going to reach a point where the growth or decline in the value of your investments each month starts to dwarf what you would typically contribute out of pocket under reasonable circumstances. For instance, say that George and Jackie are nearing retirement and have been using a value averaging approach to fund their nest egg, which is invested in the S&P 500. Currently, their nest egg is valued at around $2 million, but they want to have at least $2.5 million by the time they retire, since that'll allow them to live on a $100,000 a year income according to the 4% rule. When they started putting money away, they decided that they wanted to retire in 40 years. So the value of their nest egg had to rise by roughly $5,200 a month. At this point, that's not hard to achieve most months, as they'd only need a 0.26% return on their investments to reach their goal. However, if a major market downturn happened now, they would need a lot of cash to make up the difference and hit that target. Say if something like 2020 happened at this point. Their investments fall by about 30% or $600,000. However, their value path remains unchanged. Their net worth target for the end of this month is a little over $2,005,200. So they'll need to find a way to contribute some $605,200 to hit that target, or risk falling short of their retirement goals and having to push their retirement party dates back a few years. Now, if they've had some strong performances recently, like we did in the 2010s, and had sold some of their investments and actually kept that money on the sidelines or in some very safe, stable account, this might not actually be a problem. They just pull that cash out, put it into their investments, and move on with life. But following this approach over a long period of time can sometimes lead to you having a cash pile that's worth almost as much, if not even more, than your actual investments. And the possibility of having a couple $1,000,000 of cash lying around, making little to nothing when your investments are doing great, can be a major temptation for some investors. A temptation that, if given into, can lead to running out of the cash you need to hit your targets in the future. A fourth potential con are, of course, the tax consequences that come from selling your investments. The severity of these consequences obviously vary wildly from person to person and transaction to transaction, depending on whether you'd be realizing short or long-term capital gains, but unless you add in some rules surrounding when, or if, you're allowed to sell your investments following market run-ups, this is something to be taken into consideration. So those are the most notable pros and cons to each approach that I came across while researching for this video. With those being laid out, which approach has tended to work best historically? To answer this question, I ran a few different simulations using Robert Shiller's S&P 500 data, which goes back to January 1871, and the following assumptions. First, I used a 40-year time horizon. Second, I used an estimated 10% nominal annualized return per year and no change in the size of the baseline contribution, both of which of course are used to help calculate how much our hypothetical investor is personally contributing each month based on the formula that you see on your screen now. Our dollar cost averaging scenario will contribute the amount indicated by this formula, in this case a little bit over $1,400 a month, whereas the value averaging investor will use this figure as a baseline but may adjust it up or down in order to hit the value averaging target each month. Third, I assume there was $10,000 in startup lump sum cash, which our dollar cost averaging scenario will invest over the course of the first year of each simulation, and the value averaging scenario will use to hit their value path targets if necessary. And fourth, a savings goal of $5 million. Of course, if the value averaging strategy has cash on the sidelines left at the end of the simulation, which they normally will, that is counted towards the savings goal as well. Using that data and those assumptions, here's what I found. Based on the over 1,300 potential starting months between 1871 and the end of 2020, a dollar cost averaging approach outperformed a value averaging approach roughly 73% of the time. And as you see on your screen, it wasn't by a particularly small amount. As you can see, the value averaging approach did hold an edge in terms of the minimum ending net worth after 40 years. So there is that, but in the vast majority of cases, it fell short of a simple dollar cost averaging approach. I also reran the simulations using different return assumptions, time horizons, startup cash levels, and savings goal just to see if the story would change, but it didn't really. The exact numbers and margin of victory obviously did change, but the overall story remained the same. Dollar cost averaging came out ahead anywhere from 70 to 90% of the time, and value averaging almost always had an edge in terms of minimum net worth figures. The one simulation I ran where that wasn't true was a 10-year time horizon with a $100,000 savings goal, an 8% estimated return with no contribution changes, and a $10,000 lump sum of cash. In that case, the dollar cost averaging approach actually had a minimum ending net worth about $3,000 higher than the value averaging one, about $44,800 versus $41,700. But I didn't stop there. I also ran the simulations using a third option where a hypothetical investor simply dumped their entire lump sum of cash into the markets right away and then invested consistently, just like he would for dollar cost averaging for the rest of the simulation. And in terms of performance, that ended up beating our dollar cost averaging approach in roughly 70% of cases, regardless of the assumptions used. Though it usually wasn't by a huge margin unless I was using a really large startup cash assumption. And it also beat value averaging anywhere from 75 to 90% of the time. The drawback is, of course, that it did have lower minimum net worth figures than dollar cost averaging or value averaging in some cases. So there you have it. Based on the historical data we have available to us, it seems that a dollar cost averaging approach will usually usually lead to you having a larger nest egg than a value averaging one. But the value averaging approach can offer some additional worst case scenario protection due largely to not being fully invested in the markets at certain points, and it tends to lead to a much smoother net worth growth trajectory. And just tossing as much money as you can into the markets as quickly as possible generally leads to an even larger nest egg than dollar cost averaging. But in those worst case scenarios may not offer quite as much downside protection. And before I go, I want to give a huge thank you to George Cow, whose generous support over on Patreon is helping to keep this channel in the black. Thank you, George, for helping to support the continued creation of these videos. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.